Warren Buffett has never tried to predict where markets are headed next year or even next decade. His success comes from preparation, not forecasting. As 2026 approaches, uncertainty around inflation, interest rates, technology, and global stability continues to grow. Buffett's response to uncertainty has always been the same: follow a disciplined checklist that works in good times and bad. This checklist is not designed to beat the market every year. It is designed to protect capital, reduce mistakes, and allow wealth to compound steadily over time. While many investors react emotionally to headlines, Buffett relies on principles that remain effective regardless of conditions. For Americans navigating an unpredictable financial environment, this checklist matters more than ever. It focuses on behavior, risk control, and long-term thinking, qualities that quietly separate successful investors from stressed ones. Before we continue, subscribe, and share this video. Not for trends or predictions, but for disciplined investing. Warren Buffett's principles work because they reduce mistakes and protect capital over time. If more Americans followed this checklist early, fewer would invest emotionally. Stay with us to learn how to prepare wisely for 2026. The core principle: don't predict, prepare. At the heart of Warren Buffett's investing philosophy is a simple belief. The future cannot be predicted reliably, but portfolios can be prepared responsibly. Buffett does not attempt to forecast recessions, crashes, or booms. Instead, he builds resilience into every decision. Preparation means owning strong businesses, avoiding unnecessary risk, and keeping flexibility. This principle removes pressure to act constantly. When investors stop trying to predict short-term outcomes, they make fewer emotional mistakes. Preparation focuses on what can be controlled: price paid, quality owned, and risk taken. Buffett believes investors fail more often from overconfidence than from bad luck. By preparing rather than predicting, Americans can navigate uncertainty without panic. This mindset allows steady progress even when markets are volatile. Buffett's checklist is built entirely around this idea. Prepare your investments so they make sense in almost any economic environment. 1. Protect capital before chasing returns. Warren Buffett's first rule of investing is simple: never lose money, and understand what that truly means. He is not referring to short-term price fluctuations, but permanent loss of capital. Before chasing returns, Buffett ensures that no decision can cause irreversible damage. High returns are meaningless if a portfolio cannot survive downturns. Many investors focus on upside potential while ignoring downside risk. Buffett does the opposite. He would rather accept moderate returns than risk large losses. This approach protects compounding, which only works when capital remains intact. As 2026 approaches, protecting capital becomes especially important amid uncertainty. Americans who prioritize safety first give themselves time, flexibility, and peace of mind. Buffett's checklist starts here because once capital is preserved, growth becomes a natural byproduct over time. 2. Only invest in what you fully understand. Buffett avoids investments he cannot clearly explain. If a business model is confusing, complex, or dependent on unpredictable factors, he walks away. Understanding reduces risk more effectively than diversification alone. When investors know how a company makes money, why customers stay loyal, and what could realistically go wrong, they are less likely to panic during volatility. Buffett believes ignorance is the greatest risk in investing. As markets evolve toward 2026, complexity will increase, not decrease. New products, financial instruments, and technologies will promise high returns while hiding risks. Buffett's checklist filters these out. Americans who follow this rule protect themselves from hype-driven mistakes. Understanding creates confidence, and confidence supports long-term discipline. If you cannot explain an investment simply, Buffett would argue you should not own it. 3. Favor businesses with durable advantages. Buffett looks for businesses with durable competitive advantages, often called economic moats. These include strong brands, pricing power, customer loyalty, and cost advantages that competitors struggle to replicate. Durable advantages allow businesses to remain profitable through inflation, recessions, and competitive pressure. As 2026 approaches, companies without moats may struggle as costs rise and competition intensifies. Buffett prefers businesses that can pass costs to customers without losing demand. These companies generate steady cash flows and require less guesswork. Investing in durability reduces the need for constant monitoring. Americans who focus on quality over excitement reduce stress and improve long-term outcomes. Buffett's checklist emphasizes durability because temporary success fades, but sustainable advantage compounds. Strong businesses protect investors even when economic conditions weaken. 4. Ignore market noise and predictions. Buffett famously ignores market forecasts, political headlines, and economic predictions. He believes noise distracts investors from what actually matters. Markets fluctuate daily, but business value changes slowly. Reacting to headlines often leads to emotional decisions that hurt returns. As 2026 approaches, news cycles will likely become louder, not clearer. Buffett's checklist filters out distraction by focusing on fundamentals. Instead of asking where markets are headed, he asks whether a business remains strong. This discipline allows him to hold investments through volatility without stress. Americans who ignore noise protect themselves from fear-driven selling and greed-driven buying. Buffett's approach encourages patience and clarity. Long-term success comes from staying focused, while others react emotionally to short-term events. Kata 5. Strong cash flow matters more than exciting growth. Buffett prefers businesses that consistently generate cash over those chasing rapid expansion. Cash flow provides flexibility, stability, and resilience. Growth without cash often relies on borrowing or constant reinvestment, increasing risk. As 2026 approaches, companies with weak cash flow may struggle under higher costs or tighter conditions. Buffett's checklist prioritizes predictability over excitement. Businesses that generate steady cash can survive downturns, pay dividends, and reinvest intelligently. Americans who focus on cash flow reduce reliance on optimistic assumptions. Cash flow reveals the true health of a business. Buffett believes excitement fades, but cash endures. This principle helps investors avoid overpaying for growth stories that may not deliver. Reliable cash flow supports compounding and long-term confidence. 6. Debt is a risk multiplier. Use caution. Buffett treats debt with caution because it magnifies mistakes. While debt can increase returns, it also increases vulnerability. Even strong businesses can fail if burdened by excessive leverage during downturns. As 2026 approaches, interest rate uncertainty makes debt riskier. Buffett avoids companies and strategies that rely heavily on borrowing. His checklist favors balance sheet strength and financial flexibility. Americans who reduce leverage lower stress and increase survival odds. Debt removes options when conditions change. Buffett believes staying solvent matters more than maximizing returns. Avoiding excessive debt allows investors to ride out volatility calmly. This principle protects portfolios from forced selling and irreversible losses. Debt can accelerate growth, but it can also accelerate failure. Buffett's discipline keeps risk contained. 7. Hold cash as strategic flexibility. Warren Buffett never views cash as idle or wasted. He sees it as strategic flexibility. Cash provides the ability to act when others cannot. During market stress, investors without cash are forced to sell, often at the worst time. Buffett keeps cash so he never has to make decisions under pressure. As 2026 approaches, uncertainty around rates, growth, and global stability makes flexibility more valuable. Cash allows patience. It creates optionality. Buffett does not hold cash to earn returns. He holds it to avoid mistakes and seize opportunities when prices become attractive. Americans who dismiss cash entirely often discover too late that liquidity matters most when markets are stressed. Buffett's checklist treats cash as insurance and opportunity combined. It reduces risk without sacrificing long-term potential. 8. Buy with a margin of safety. Buffett insists on buying investments at prices well below their intrinsic value. This margin of safety protects against bad luck, misjudgment, and unexpected events. Even strong businesses can disappoint. Paying too much leaves no room for error. As 2026 approaches, valuation discipline becomes increasingly important. Optimism can inflate prices beyond reality. Buffett's checklist prevents this by requiring a buffer between price and value. This approach reduces downside risk while preserving upside potential. Americans who demand a margin of safety reduce emotional stress and improve long-term outcomes. The goal is not perfection, it is protection. Buffett understands that mistakes are inevitable. Margin of safety ensures those mistakes are survivable. Over time, this discipline compounds quietly and consistently. 9. Time in the market beats timing. The market Buffett does not attempt to predict market tops or bottoms. He stays invested in quality businesses for long periods. Missing a few strong years often causes more damage than enduring temporary downturns. Buffett's checklist favors endurance over precision. As 2026 approaches, volatility may increase, tempting investors to jump in and out. Buffett avoids this behavior entirely. Staying invested allows compounding to work uninterrupted. Timing mistakes often stem from emotion, not logic. Americans who focus on long-term ownership reduce stress and improve returns. Buffett's success demonstrates that patience outperforms prediction. Time rewards discipline. Markets recover, but lost time does not. This principle protects investors from their own impulses. 10. Emotional discipline is non-negotiable. Buffett often says investing success depends more on temperament than intelligence. Fear and greed cause investors to buy high and sell low. Buffett's checklist removes emotion by enforcing rules. When markets fall, fear pushes people to sell. When markets rise, greed pushes them to overpay. Buffett does neither. He remains calm because his decisions are grounded in fundamentals. Emotional discipline allows rational thinking during volatility. As 2026 approaches, emotional pressure may increase. Investors who lack discipline may sabotage themselves. Buffett's approach prioritizes behavior over brilliance. Americans who control emotion protect capital and compound steadily. Emotional discipline is not about ignoring risk, it is about responding thoughtfully instead of reactively. 11. Focus on after-tax, after-inflation returns. Buffett evaluates investments based on real returns, not headline numbers. What matters is what money can actually buy in the future. Taxes and inflation quietly erode nominal gains. As 2026 approaches, these factors become increasingly relevant. High returns lose meaning if purchasing power declines. Buffett's checklist accounts for this reality. Americans who ignore after-tax and after-inflation effects may feel progress while falling behind. Real wealth is measured in preserved purchasing power. Buffett emphasizes efficiency, not excess. Understanding real returns leads to better decisions and realistic expectations. This principle encourages thoughtful planning rather than speculation. Real gains compound, and illusions don't. 12. Think like an owner, not a trader. Buffett invests as if he is buying the entire business, not trading price movements. Ownership thinking shifts focus from short-term fluctuations to long-term value. Traders react to price. Owners evaluate performance. As 2026 approaches, this mindset becomes increasingly important amid volatility. Ownership encourages patience, accountability, and discipline. Buffett ignores daily price changes because they do not alter business fundamentals. Americans who adopt ownership thinking reduce stress and improve outcomes. Trading invites emotion. Ownership invites clarity. Buffett's checklist emphasizes commitment to quality over constant activity. Businesses create wealth over time. Prices merely reflect sentiment in the short term. Ownership thinking aligns investors with long-term success. Warren Buffett's 2026 investment checklist is not exciting, but it is effective. It does not promise quick wins or perfect timing. It protects against costly mistakes and emotional decisions. Markets will change. Headlines will create fear. Predictions will come and go. But this checklist remains relevant because it is built on discipline, patience, and common sense. Americans who follow it won't feel rushed by uncertainty. they'll feel prepared. Buffett's success came not from guessing correctly, but from behaving consistently. This checklist offers the same advantage. Those who apply it quietly reduce risk while allowing compounding to work over time. In 2026, preparation will matter more than prediction, and this checklist is designed to do exactly that: prepare.